In November 1910, 7 of the most powerful men in America quietly boarded a private train under the cover of darkness. They were instructed not to use their real names. They pretended not to know one another. Their destination was a small private island off the coast of Georgia. What happened there remained hidden from the public for years. But many historians agree on one thing. The meeting changed the way money and power would shape the modern world forever. At first glance, the story almost sounds impossible. How could a meeting attended by just 7 men on a remote island become one of the most influential events in modern financial history? After all, economies aren't built in secret meetings. They are built by millions of workers, businesses, consumers, and governments, making decisions every single. That's exactly why the events at Jekyll Island have fascinated historians, economists, and political thinkers for more than a century. Not because 7 men suddenly gained the power to control the world overnight, but because they were attempting to solve a problem that had already pushed America's financial system to the edge of collapse. Just 3 years earlier, in 1907, the United States experienced one of the worst banking panics in its history. Banks failed. Credit evaporated. Businesses shut down. Ordinary people rushed to withdraw their savings, fearing the system itself was breaking apart. The crisis exposed a dangerous reality. The world's fastest-growing economy had no effective mechanism to stabilize its own financial system when panic spread. What followed was not simply the creation of a new institution. It was the beginning of a debate that has never truly ended. Who should have the power to create money, control credit, and intervene when an entire economy begins to collapse? At this point, it's tempting to see Jekyll Island as nothing more than the birthplace of the Federal Reserve. But that would be missing the bigger story. The real issue isn't whether 7 influential men gathered in secret. It's why societies repeatedly place extraordinary power into the hands of institutions that control money. Throughout history, kingdoms fought over land. Empires fought over resources. But as the modern economy emerged, a different kind of power began to matter more than either of them. The power to decide when money is created, where credit flows, who gets access to capital, and who is left waiting when financial panic spreads. Jekyll Island wasn't simply about founding an institution. It was about redesigning the rules of the financial system itself. And once you begin to see that, the story is no longer just about America's past. It's about understanding one of the most influential systems still shaping the world today. This is Mind Over System, where we break down the hidden systems and invisible rules that shape economies, power, and ultimately, the choices that influence every one of our lives. To understand what happened on Jekyll Island, we first have to understand the problem that brought those men there in the first place. Contrary to what many people assume today, the United States at the beginning of the 20th century wasn't suffering from too much government control over money. In many ways, it was suffering from too little coordination. America's economy was expanding at an extraordinary pace. Railroads connected the continent. Factories multiplied. International trade accelerated. Banks appeared everywhere. Wealth grew rapidly. But beneath that impressive growth was a fragile financial system that depended almost entirely on confidence. Every bank accepted deposits from ordinary people. Every bank issued loans. But unlike the image most people have today, banks did not keep every dollar that customers deposited. They couldn't, because lending was precisely how banks generated profits. Under normal circumstances, this worked remarkably well. Depositors rarely demanded all of their money at the same time. Businesses borrowed, invested, expanded, hired workers, and repaid their loans. Money kept circulating. The economy kept growing. But this entire system relied on one invisible assumption: that people would continue believing their money would still be there tomorrow. The moment that belief disappeared, the entire machine began working in reverse. Depositors rushed to withdraw cash. Banks suddenly needed money they no longer physically held. Healthy businesses lost access to credit. Companies unable to refinance their operations were forced to close. Workers lost their jobs. Consumers stopped spending. Fear spread faster than facts. This wasn't simply a banking problem. It became an economic chain reaction. That is exactly what happened during the Panic of 1907. A series of failed financial speculations triggered widespread fear. Depositors rushed to withdraw their savings. Liquidity vanished across the banking system. Businesses that had nothing to do with the original crisis suddenly found themselves unable to borrow money simply because confidence had collapsed. At that moment, America faced a question that no rapidly industrializing nation could ignore. If panic could destroy an economy faster than poor productivity ever could, then who should have both the authority and the resources to stop that panic before it consumed the entire financial system? That question, not conspiracy, was what ultimately brought 7 influential men to a secluded island off the coast of Georgia in November 1910. When the 7 men arrived at Jekyll Island, they weren't starting from a blank sheet of paper. They had to spend months studying the financial systems of Europe, particularly the central banks of England, France, and Germany. Those countries had experienced banking crises before, but unlike the United States, they already possessed institutions capable of coordinating the flow of money during moments of panic. America did not. Every major bank was largely left to protect itself. When confidence collapsed, there was no single institution responsible for restoring it. The financial system behaved like a city with thousands of firefighters, but no fire department. Each bank could save itself. None could save the system. That was the problem Jekyll Island attempted to solve. During the discussions, the goal wasn't simply to establish another bank. It was to design an institution that could stand above individual banks without replacing them. An institution capable of supplying liquidity when private money disappeared, coordinating credit when fear overwhelmed rational decision-making, and acting as the lender of last resort when no one else was willing to lend. These ideas may sound technical today, but at the time, they represented a profound shift in how financial power would be organized. Until then, money had largely followed the decisions of countless independent banks. Afterward, an increasing share of financial stability would depend on one central institution capable of influencing the entire system. That shift came with obvious advantages. A coordinated response could prevent panic from spreading across the country. Healthy businesses might survive temporary crises. Depositors could regain confidence before fear destroyed otherwise functioning banks. But every solution creates a new question. If one institution gains the authority to stabilize the system, who ensures that institution itself never becomes too powerful? The same tools capable of preventing financial collapse could also influence borrowing, investment, asset prices, and eventually the direction of the entire economy. That is why debates surrounding central banking have never truly disappeared. They are not arguments about whether stability is valuable. They are arguments about how much power any institution should hold in order to protect that stability. Jekyll Island did not end that debate. It simply gave it a new shape, one that continues more than a century later. More than a century later, many people still believe that a central bank's greatest power is simply the ability to print money. It sounds logical. If you can create money, you must control the economy. But reality is far more complicated. Printing money is only one small part of the story. The greater power lies somewhere else. It lies in deciding when money should enter the economy, how much should enter, where it should flow, and perhaps most importantly, when it should stop flowing. Imagine two businesses. Both are profitable. Both employ thousands of workers. Both have healthy long-term prospects. But during a financial crisis, neither can borrow enough money to pay suppliers or employees. Without access to credit, even successful companies can collapse within weeks. That is why modern economies don't simply run on money. They run on the continuous movement of credit. Credit allows businesses to expand, families to buy homes, entrepreneurs to build companies, governments to finance infrastructure. The moment that flow slows dramatically, the entire economy begins slowing with it. This is why interest rates matter. This is why liquidity matters. This is why confidence matters. A central bank rarely tells people what to do. Instead, it changes the environment in which everyone makes decisions. Lower borrowing costs encourage investment. Higher borrowing costs discourage excessive risk. More liquidity supports spending. Less liquidity forces caution. Millions of individuals continue making their own choices. Yet those choices are heavily influenced by the financial conditions surrounding them. That is a very different kind of power. Not the power to command, but the power to shape incentives. And history has repeatedly shown that shaping incentives often changes behavior more effectively than issuing orders. This is precisely why institutions that oversee money occupy such a unique position in modern society. They don't merely react to economic activity. They influence the conditions under which economic activity takes place. That influence can help stabilize a nation during moments of crisis. It can also produce unintended consequences if used poorly, misunderstood, or left without sufficient accountability, which is why the debate surrounding central banking has never really been about money alone. It has always been about power. Who exercises it? Under what rules? And in whose interest? If all of this sounds abstract, history offers several moments when the influence of central banking became impossible to ignore. During the Great Depression of the 1930s, the collapse of banks and the contraction of credit deepened one of the worst economic crises the modern world had ever experienced. Economists continue debating exactly what should have been done differently, but few disagree on one lesson. When confidence disappears, the consequences spread far beyond Wall Street. Decades later, during the global financial crisis of 2008, central banks once again stepped in as lenders of last resort. They lowered interest rates, expanded liquidity, and introduced extraordinary measures to prevent the financial system from freezing completely. Then came 2020. As the COVID-19 pandemic brought economies to a sudden halt, central banks around the world responded with unprecedented speed. Trillions of dollars in liquidity were injected into financial markets, while governments launched massive fiscal support programs to prevent businesses and households from collapsing under the weight of an unexpected global shutdown. Yet every intervention came with trade-offs. Policies that helped stabilize financial markets also contributed to new concerns about inflation, rising asset prices, growing public debt, and widening wealth inequality in the years that followed. The pattern appears again and again throughout modern history. Financial crises demand decisive action. But the greater the power used to solve today's emergency, the more important tomorrow's questions become. Not whether intervention should exist, but how that intervention should be exercised, limited, and held accountable. Imagine two families living on the same street. Neither family follows central bank meetings. Neither reads economic reports. Neither knows what happened on Jekyll Island more than a century ago. Yet both will eventually feel the consequences of decisions made far above their daily lives. The first family buys a home when interest rates are low. Their monthly mortgage payments are affordable. They renovate the house, spend more in local businesses, and gradually build wealth as property values rise. A few years later, inflation begins accelerating. Interest rates increase. Borrowing becomes more expensive. New home buyers can no longer afford the same prices. The housing market slows. Businesses delay expansion. Hiring weakens. The second family has a different experience. They planned to open a small manufacturing company. The business model was solid. Customers already existed. Investors showed interest. But as credit tightened, financing became too expensive. The project was postponed, not because demand disappeared, not because the idea failed, but because the cost of money changed. Neither family ever voted on those decisions. Neither family attended policy meetings. Yet both adjusted their lives in response. One delayed buying a home. The other delayed creating jobs. Neither decision was forced. Both were simply responding to a different financial environment. And that is how monetary power often works. Not by giving direct orders, but by quietly changing the incentives that shape millions of individual decisions every single day. The story of Jekyll Island is often told as if it were only about bankers, politicians, or the birth of the Federal Reserve, but that is far too narrow. The real significance of those 9 days extends far beyond one institution or even one country. It reveals a pattern that has repeated itself throughout history. As societies become larger, wealth becomes more interconnected, and economies become more dependent on one another. Stability itself becomes a form of power. The more complex the system becomes, the more valuable the institution that can preserve that system becomes. But complexity comes with a paradox. The very institution created to reduce uncertainty gradually becomes one of the most influential forces shaping the future of that society. Decisions made inside meeting rooms can influence interest rates across continents. They can affect whether businesses expand or contract, whether families buy homes or postpone their dreams, whether investors embrace risk or retreat into fear. In today's world, financial markets react within seconds to a single sentence spoken by a central bank chair. Sometimes, expectations move trillions of dollars before a single policy has even taken effect. That is a remarkable transformation. A century ago, power was measured by the size of an army. Today, it is often measured by the ability to shape expectations before anyone fires a shot, which is why the most important question is no longer whether institutions like the Federal Reserve are powerful. That much is obvious. The real question is whether any society can safely concentrate so much influence over money, credit, and confidence without continuously demanding transparency, accountability, and public trust. Looking back, it is easy to become fascinated by the secrecy of Jekyll Island. The private train, the false identities, the closed-door meetings. But history has a way of distracting us with dramatic moments while quietly hiding the deeper lesson. The island was never the true source of power. The real source of power was the system that emerged afterward. Because in every modern economy, money is more than a medium of exchange. It is a coordination system. It tells businesses when to invest. It tells consumers when to spend. It tells investors how much risk to accept. It tells governments how expensive the future has become. Most people believe they make financial decisions independently. In reality, every decision is made inside an environment shaped by incentives, expectations, and confidence. Change those conditions, and millions of individual choices begin changing on their own. That may be the most subtle form of power ever created. Not the power to command people, but the power to influence the conditions under which people believe they are choosing freely, which means the lasting legacy of Jekyll Island was never simply the creation of a central bank. It was the recognition that in the modern world, the greatest influence often belongs not to those who control people, but to those who shape the systems within which people make their choices. Understanding Jekyll Island is not about deciding whether the Federal Reserve was right or wrong. Reasonable people have debated that question for more than a century, and they likely will for generations to come. The more valuable lesson is something else. Every modern society depends on systems that most people rarely notice until those systems begin to fail. Money is one of them. It quietly influences investment, employment, innovation, and opportunity long before it appears in headlines. The better we understand how those systems work, the less likely we are to mistake every economic boom for permanent prosperity, or every crisis for random bad luck. Because once you begin seeing the rules beneath the headlines, you stop reacting only to events. You start recognizing the forces that make those events possible in the first place. More than a century has passed since a small group of men gathered on a quiet island to discuss the future of America's financial system. History will continue debating what their intentions were. But perhaps the more important question is no longer about them. It's about us. In a world where trust can move markets, expectations can reshape economies, and invisible systems influence billions of lives, how many of the rules that shape your future do you truly understand? And how many do you simply accept because they've always been there?